Now, I'm not going to get into what we think interest rates are going to do, but Graham, you invest in quite a few financial companies. And is this something that is on your radar? Is it important to your investment thesis? What direction interest rates are going?
I think as an equity investor, you do want high returns even in a low interest rate environment. So if the base rate is 2% or 4% or something reasonably normal, I think your expectations as an equity investor should be pretty much the same because you want something that's a lot higher than that anyways.
Hello and welcome to the Investors Roundtable, a three-way discussion where Mark Simpson, Graham Neary, and myself, Roland Head, talk about shares, portfolios, and the markets. I like reliable dividends, Graham likes quality compounders, while Mark looks for deep value. This time, we're discussing packaging group Macfarlane, construction firm VANL Holdings, and estate agency chain Property Franchise Group. Let's get started.
Hi, guys. Good to see you again.
Hi, Mark. Good to be here.
Hi, Mark. Nice to see you again.
Let's dive straight in today. Graham, you're going to take us through a property business.
Yeah, so Property Franchise Group, the ticker TPFG, is a company I followed for several years. It's always had very nice results in terms of cash flow, return on equity. It's a capital-light business model, so the franchisees take a lot of the risk, do a lot of the work, and Property Franchise Group collects the management service fees. These estate agency brands that it controls are very well known. They've been around for a long time, 150 years in some cases. They've got the likes of Martin and Co, Hunters. But the big news at Property Franchise over the past little while has been the all-share merger with Belvoir, which had the ticker BLV. I used to study them both, and I probably studied Property Franchise a little bit more. I think they gave me a CEO interview at one point, which maybe meant that I was focusing a little bit more on them. But yeah, both companies were very highly thought of. However, they never really traded on very high earnings multiples, which may be related to the property risk. People hear property and they think cyclical, but these companies have performed very well, even in bad years for the property market. So last month, Property Franchise published its results for 2023. 2023 was a pretty bad year in the property market. I think most people would agree. And yet revenue was stable. There was very little change in profits. Profits maybe up a little bit on a pre-tax basis. And they kept the dividend the same. So in a very bad year for the property market, their results were basically stable. And a lot of that is to do with the fact that they have recurring revenue from lettings. And when the mortgage market is poor, people aren't able to draw down the mortgages that they'd like to for a variety of reasons, especially interest rates, that seems to be reflected in a rental market where people need to rent. And Property Franchise saw good growth in its lettings related revenues. So there's this kind of balancing between them where one goes down, the other goes up. And in a strong market, I think that you'd see that sales revenue would be strong and probably you'd get good overall growth in Property Franchise as we saw in previous. But anyway, with Belvoir joining Property Franchise, we're talking about a company now with revenues of over £60 million and pre-tax profit of £18 million based on 2023 numbers. Hopefully 2024 will be a little better. But I suppose that gives you a clue about the very high profit margins we're talking about here, where £60 million of revenues turns into £18 million of pre-tax profits. Very high revenues. Again, because it's a franchise-based model, the cash flow statements will back up the high quality of the business. The dividends also are well afforded. There's no debt involved here either in terms of Property Franchise. And since it was an all-share deal, there's no debt involved there either. I think the stock is currently trading at about 14 times earnings, which is maybe a little high on a historical basis, but it has traded higher than that. And
so that's 14 times forward earnings.
Yes.
Yeah, for the
Yes.
combined
Yeah.
for the combined business.
For the
Yeah.
combined business.
For the combined business. Now, the Belvoir CEO and CFO, I think that they're still involved in terms of helping the transition, but it's really the property franchise executives who are still running the show here. And so we do get a strong sales market, say 2 years from now. I think you could get some decent growth here. And even if the sales market remains poor, I think the majority of revenues here are now recurring thanks to the huge lettings business. So I think this is a very nice share to hold for the long term. Obviously, I'm not in a position to be able to recommend stocks, but this is just one that I'm a big fan of. And I'd be keen to hear if you agree.
Yeah, I've always liked it for similar reasons to you, and I've always looked at Belvoir. I would have said in the past I haven't had a clear reason maybe to choose between Belvoir and property franchise. Certainly, they've provided quite nice income streams in recent years, and I think the forecasts on Stockopedia are suggesting some quite generous dividend growth this year, with the combined business maybe benefiting from economies of scale and so on. I suppose one reservation I might have at the moment, because it's two businesses, it's quite a large combination, I think, for the size of each of these businesses. So I might be interested to see the first set of consolidated accounts that include both businesses, maybe before I thought about investing at the moment.
Tricky situations, isn't it? Because unless they produce more accounts and then forecasts, you're a little bit blind with how you're making these kind of judgments. So is that something you're concerned about, Graham? Would you like to see these accounts, or do you think they're simple enough to combine and take the combined view?
They did give us the combined numbers for 2022 and 2023. So that's where I got my 61 million pounds of revenue converting to 18 million pounds of PBT. That is a pro forma number for 2023.
I think the consensus I can see on Stockopedia is 60 million of revenue for 24. So it doesn't look like there's been any kind of upgrade to the expectations yet. It looks like they might think it's the expectation is for quite a flat year, possibly, unless there's any synergies, cost savings, and so on coming through.
Again, it's one where you hope that consensus has been updated to reflect that, but it's not certain, is it? I think that's the who are the brokers?
I think there's a note from Singer recently on research that's available. Yeah, so I think the 60 million revenue consensus number must be for the combined group.
Yeah, there's only 2 brokers on Wikipedia, so it's not like you've got 10 brokers and one's got the old number in it. Yeah, I think you're right. I think it must be that is a little concerning, isn't it? That the combined business is doing worse potentially this year than the previous year.
Yeah, although it's always going to be external factors, really, isn't it? I think that there's only property sales. I think I don't know if it's true to say generally property sales are a little bit more profitable than rentals, but rentals do provide that recurring income, don't they?
I think the point about the merger is that they're such similar businesses, really exactly the same business model, but with slightly different points of emphasis, that to me, it's almost a no-brainer. Why not join up? You'll benefit from each other's strengths. You'll smooth out each other's weaknesses. If you're a fan of Mortgage Advice Bureau, which I am, I think that's a very nice share. Belvoir has, in the words of Property Franchise Group, a well-established financial services division. So Belvoir has been a little bit more weighted towards mortgage broking through that partnership with Mortgage Advice Bureau. My understanding is that Property Franchise Group wanted to expand its mortgage broking division, and instead of building it from scratch, they basically get to pick up the one that Belvoir has.
It makes sense, doesn't it? That sort of strategy of why build it when you can, both businesses are very similar rating, you just merge. And yeah, I'm not convinced there's a lot of synergy in terms of, obviously they're saving some management costs, but I'd imagine that the Belvoir management will have been retained, certainly in the short term, on generous packages, but to get them to agree to this sort of deal.
I think they're only staying for a year.
Right.
That's it then. Even small things like the listing costs and accountancy costs and all those professional services, they all get stripped out as well. I think there are those benefits. Maybe they're not huge, but they are there. And then also for UMove, EWE Move, the hybrid agent that TPFG owns, maybe there's some benefit there in terms of the merger as it continues to expand. It's now part of an even larger group as it continues its expansion throughout the UK. So I don't think there are any real downsides to the merger. I think there are only upsides. I guess market share is still going to be pretty low. If you were to look at the entire estate agency market, it's still going to be a very low market share, but there is that lessened competition. And from a stock market investor point of view, the only real alternative now, I think, is Winkworth, which is a very small business, 20 million.
I think, yeah, Maynard Patton, one of our previous hosts, was a holder of that for quite some time. I think we had a bit of debate about that in the past.
It's quite a bit smaller, but
yeah, slightly different business.
Quite a nice business, but maybe not much growth, or there doesn't seem to have been that much growth in terms of new outlets and so on. But yeah, I was just looking at this at the merger then. So to an idea of scale, I think they'll have somewhere over 900 franchise locations, the combined group, 930 possibly. So it's small by, I suppose one thing that won't happen is that they won't combine. There won't be any incentive to combine different franchise fascias, if you like, will there? Because it makes sense for market share and for visibility to have these multiple ones, even though they might be owned by property franchise, multiple locations in the town, for example. But those costs are borne solely by the parent in this case, being franchises. So that's not such an issue as with some mergers where they're trying desperately to combine as many things as possible.
And I'm sure the franchisees will continue to compete very aggressively on the ground with each other. But from a parent company point of view, if you own the Martin and Co brand and the Hunters brand and all these other brands, Belvoir, there is that sort of relaxed state where the competition between them is, in a sense, probably good for us. And if prices go up or down, actually, we don't really want them to compete too much on price as a parent company. I only see positives. I should just mention that there's one other company which I noticed recently, LSL Property Services, with the ticker LSL, and that might also be worth looking into because it does have some estate agency branches as well, although it does many other things. But just in terms of telling people, giving a perspective on the industry, we've got TPFG, we've got Winkworth, which is very small, and then LSL may also be of interest, and that's a bigger company, more diversified. But yeah, that's my overview. I don't know if you guys have any final thoughts on that, or should we move on?
Yeah, just the thing for me is like a little bit of lack of operational gearing in there. So obviously the return on capital numbers seem to be pretty good, but the revenue, at least according to Wikipedia's numbers, are growing very much faster on the top line than the bottom line, and then the free cash flow a little bit slower than that. And yeah, I wonder whether there's a little bit of vanity in this. But again, I find that very hard to see from the numbers now that this company's merged. It's harder to see the combined long-term effect of that. Yeah, I don't think it's a bad company. I don't think I probably not tempted at the sort of 14, 15 P level personally, but especially as there's no tangible book value to protect the downside if things go wrong. But net cash, it's an unlikely situation that it gets itself into trouble, I think, but still not quite cheap enough for me, but a decent company, I think.
Yeah, I suppose the only other thing to point out in terms of context and alternatives is Foxtons, of course, is a bit of a London specialist. This isn't a franchise business. I think they control all their own branches, and it's quite a different business, but they seem to be doing a lot better than they have been for a period. And it has some quite different characteristics to the big franchise change. So it might be an interesting comparison for kind of understanding how the market works. But yeah, I think I agree with you really, Mark. I might have been tempted maybe when it looked a little bit cheaper, but for now, yeah, probably not one I'd rush into right now. But I agree, it isn't necessarily expensive, just not necessarily cheap.
What are you rushing into? What's your one that you've got for us?
Yeah, this one that's caught my eye just recently is another small firm. This is a packaging business called Macfarlane. Ticker MACF, and it has a market cap of about 200 million, and it's been listed on the main market since 1973. So this isn't not an AIM stock, although it's a small one. It's been on the proper market for a long time, and I think the shares slipped last week as we're recording this, because the company put out an AGM trading update, and they said that sales during the first quarter were 9.5% lower than during the same period last year, which obviously doesn't sound like a brilliant result. Q1 profits were also said to be a bit lower, but the company didn't give a number, but they did say the impact was offset to some extent by strong gross margins and the benefit of acquisitions. The company, interestingly, I think they also left guidance for the full year unchanged. And looking at the latest broker note and consensus numbers, that they haven't changed either. So I think this wasn't one of these situations we've seen recently where there's been a stealth profit warning. The company said nothing and the brokers have cut their forecast. This hasn't happened here. It seems to have been left unchanged. So I thought it was interesting because I like Macfarlane quite a bit. I've looked at it before and the price has done well recently. But one possible reason that's a little bit more innocent for the shortfall in revenue may be the exposure to commodity prices, although they do talk about weaker consumer demand or weaker end user demand as well. Packaging is quite is very much a commodity business in some ways. They have quite a lot of exposure to raw material pricing, and I think that often is an element of that is passed through. So prices do tend to go up and down, slightly lagging the raw material commodity prices from what I understand. So I think it's credible to say that it could be credible to think the revenue is down, but profits may still be broadly on track. And I suppose more broadly, I think the business has quite a long and incredible record in terms of delivering growth and delivering on its guidance.
I would say it's compounded, like historically, the compound figures, at least for EPS, have been pretty good, haven't they? Was it Stockpedia has something like about kind of 11% on 5% CAGR revenue, so it doesn't need to grow the revenue particularly quickly, and it does seem to have some operational gearing there that helps out.
There's a few nice things about the business, or at least I like them. Like you say, the long-term growth record's quite good. I think if you look at over the last 10 years, operating profit has tripled or a little bit more than tripled. The current chief executive as well, Peter Atkinson, has been there a long time, so I think he probably has quite something of maybe a bit of an owner's eye. And one thing I like about it really is the majority of the business is a distribution model. It supplies packaging to end users all over the UK, and I think there's a bit of a bias towards industrial customers, and that's high volume, low margin, and generates about 75% of profits. But they also have a specialized manufacturing business that makes bespoke packaging for high value industrial items and so on. So this is only generating maybe 10 to 15% of sales, but I think it produced a quarter of the group's operating profit last year. And this manufacturing side has double-digit profit margins. So it's obviously has some nice characteristics to it, some pricing power with customers, and I think also some stickiness probably with customers. So I think it's quite a nice business. There's a long record of bolt-on acquisitions and organic growth. Even with some goodwill that's been added over the years, it still consistently generates return on capital around 13, 14, 15%, which I think is quite good for a business of this kind. I quite like well-run distribution businesses. I think that if they're managed well, they can throw off quite a lot of cash and get good scale. So I think the drop in prices left the shares on around 11 times 24 forecast earnings, I think, with a yield just over 3%. And to me, that doesn't look a particularly bad price at all for this business. But I'd be interested to know what you think. Mark, is this something that's appeared on your radar?
Yeah, like I've looked at it quite a few times in the past and never quite invested. It gets a lot of love from people for that sort of continuous compounding, not the lights out numbers, but fairly modest, but good growth over time. But also I'm aware that it really isn't forecast to continue doing that. The 2025 forecast is only % above that. And people point to, it's the conservative management and that kind of thing. But I read that Q1 statement and thought, they're in trouble. It was minus 9.5% on revenue. And yes, you're right. Some of it is just the effect of pass-through commodity pricing. But this should be when they make hay, right? This should be commodity pricing goes down. They keep their prices, and at least for a couple of months before passing it on to consumers or their customers. It's not really consumers, is it? But their customers. And then they keep the difference. And it feels when you get this commodity deflation. So I wish they'd give volume figures. Have you ever seen volume figures for what they actually produce or distribute? They don't produce all of it.
Yeah, I'm not sure. They certainly didn't mention volume during the first quarter. And to be fair, actually, the statement from the company didn't explicitly mention commodity prices, but they did mention gross margins. And that is a logical
logical
extrapolation
step.
from there, a logical
Yes.
step. But yeah, so it's a bit hard to say because they do talk about weak customer demand and price
Yeah.
deflation, but then they say strong gross margins. And so I know what you mean, though. When we saw, obviously, going back a couple of years when price inflation, commodity price inflation was very strong with some of the other larger packaging companies that are on the London market, you saw them talk about putting their price increases through, and there was a lag there, and then they really made hay for a while, and then now that's all rolling off. And with Macfarlane being more of a distributor in terms of the volume or the bulk of their revenue, I don't know whether that effect is less here or whether they control the pricing less, maybe the pass-through element. I don't know. It would be interesting to understand a bit more, and I guess with the half-year results probably provide a bit more on that. When say profits sales are down 10% nearly, you do have to think there's a risk it could be a bit worse. The eventual outcome could be worse.
Yeah. The other factor is that there's something like 3 acquisitions there as well. So they do these small bolt-ons. They're not like transformational acquisitions, but there's something like 3 small bolt-on acquisitions that give them, and they're not giving you like for that. A 9.5 isn't even a like-for-like sales figure. The like-for-like figure is presumably worse. So I do think there is a risk that they miss these expectations despite
I agree.
certainly. And I don't think it's bonkers expensive if you assume that they can continue growing at historical rates and that they don't miss this year. I'm not sure I'm willing to take that bet. I don't know about you, Graham. Do you think that they'll hit these figures and return to growth?
Well, I'm not sure about the short term, but I do think that this ticks many boxes, and I can understand people's love affairs with Macfarlane. If I was to try to find some niggles, maybe I could say that even though it's run like a family business in terms of long-term compounding and not seeming to take much financial risk, the insiders don't seem to be very enthusiastic buyers. It seems that Atkinson is the chief executive, right? It seems that he was a buyer a few years ago at around 30p or below. And it's great that he's been with the company so long. He did keep buying then when the price increased from that level. But then if you look at since about 24, you could say probably for the last 10 years, he's not really been buying many shares. You'd also look at the chairman and say there's been a few token purchases, but the insiders generally seem to be more about exercising their options and selling most of the shares that they get in that way, which I think is a little bit surprising considering how well they're running the company, that they're not interested in owning more of the shares. But big picture, I agree with people's reasons for liking this company. I love the fact that the acquisitions are so small. We've got all these sub £5 million acquisitions, typical bolt-on, and being funded with cash or a little bit of debt, which they can very quickly pay off. So no dilution for shareholders and very little financial risk, but the acquisitions do seem to be helping the overall growth trend here. So yeah, I would definitely view this as a quality business, and at 10 times or 11 times earnings, maybe it's a good option here.
I'm not quite convinced by the strength of the balance sheet as well. It always looks a little bit that they've run the business like this and they've not got into trouble for a long time, but the current ratio isn't particularly strong. There's almost always deferred, because they make so many acquisitions, there's almost always deferred consideration in there. And yes, so which is effectively like debt. If you agreed to pay later within the normal parameters of the business is performing, it's like debt. Yeah, I don't think they're immediately going to get themselves in trouble, but I also don't think they have the financial flexibility to do really big acquisitions that could move the needle here. There's not like a big chunk of cash sitting on the balance sheet that's ready for that sort of thing. So I'm a little bit more cautious than you, I think, on the strength of the balance sheet. But they've hardly issued any shares at all, apart from a few options over the long term. So it's that's a positive side of it. They have done these acquisitions from cash debt over time.
Yeah, in terms of the balance sheet, I suppose it's worth pointing out that although I think last week's update said there was a net cash position of 4.7 million at the end of March, and because of the business model, they do have quite a lot in receivables and payables and inventories. They're all quite big numbers. Receivables is something like, at the end of the last year, was just under 54 million, and then about 17.5 million of inventories on top of that. And the payables are also about 50 million. So these are quite big numbers, and I think it's one of the things you need in this business is to manage them well, and collections and credit terms with your suppliers and all this. And when it's done well, it does generate, I think, quite a lot of cash, but you wouldn't necessarily want to see much debt on top of all of that, I don't think, in terms of having some resilience. So net cash position is nice, but then again, I wouldn't particularly want to see the business with much additional leverage.
I think they're hinting at they're going to make another acquisition that's going to help them make the numbers for this year. But again, I'm not sure that's a necessarily positive. It's good if they make the numbers, but it's very easy to just buy a business. What you're paying for the price for the business doesn't go through the income statement, but the money the business generates does. If I thought they'd hit these numbers without any acquisitions, then yeah, I think it's interesting. But I'm starting to doubt it personally. I'd want to see a bit more evidence of a stronger Q2, for example, before investing.
Yeah, I think that's a fair point. Although with the acquisitions being so small, they probably do benefit from a bit of a re-rating effect as well, which has probably helped them over the years. They're buying the earnings more cheaply than their own earnings are rated by the market. So that has a positive effect. But I'm comfortable with the way acquisitions have been valued, because as I said, when you look at the balance sheet, there's 88 million of intangibles, and including goodwill. I'm not quite sure how much of that is goodwill, but even if you calculate return on capital, including the goodwill, which I tend to do, it stayed very stable in a kind of at a mid-teens level. So it suggests to me their assets, whatever they're buying, they're getting a nice return from, a reasonable return from over time, which I think is reassuring, or I think it's reassuring.
I'm not convinced they get a great benefit of that kind of multiple expansion. Maybe it varies, but I calculated the last acquisition, Protective Solutions, was 4.2 to 5.6 times EV to EBITDA, and they're on 6.6 historical kind of numbers. Yeah, there's a bit of juice in there, but it's not, I don't know, Judges Scientific, when in the old days, when they used to buy it at 3 times and they were valued at 15 times or anything like that. But there's a nice little turn there, isn't there? Just perhaps not getting as good value as they got in the past.
Yeah, I think that tends to happen as acquisitions get larger, as a rule of thumb, doesn't it? And yeah, and I think without the manufacturing side, the profitability would be a bit less impressive probably too. I think that's a bit more of a niche maybe. But yeah, I think it's an interesting choice, a bit different to the big packaging companies, of which there are 2 or 3 still left just about hanging on in the London market. I think at least one of them's going to be gone soon.
Yes, although they're all about manufacturing, aren't they? It's a slightly different business. Yeah, an interesting one. Definitely one I've followed in the past. I give you my pick for this week. I've been looking at a company called VANL Holdings. These guys are a provider of effectively piling rigs. They call themselves the UK's largest geotechnical engineering contractor. But what that effectively means is that they provide piling rigs for construction. They do a lot of work with motorway construction, so kind of road construction. And so that's about a third of the business revenue wise. A third of the business is specialist piling and rail. So they actually have rigs that go on the rail tracks, and instead of accessing the area you need to have piling on wheels, you access them via the rail system. And then ground engineering services. So this is more for housing construction or ancillary things like schools in that kind of area. They've not been doing great, as you'd imagine, and particularly because of, like many businesses, the access to or the exposure to the housing sector. But they look pretty cheap to me. So they have a sort of price tangible value of about 0.8. In the past, they've had a pretty poor return on capital, single figures. But I know it's a sort of focus of management to improve that. And they say that sort of part of this is being stuck with the wrong type of rigs. So it's a sort of business where your utilization matters a lot. You buy certain rigs to use, and if they're sitting idle and nobody wants a particular rig in a particular area, it doesn't generate any money, and it's actually depreciating and costing you money. So that's where they've been in the past. But they've got sort of positive exposure to a few areas that are going to be potentially growing. So one is the energy sector, particularly with electricity. The other is the rail sector. And I believe they've got a contract in Toronto as well as operating in the UK. And then water sector as well. These are areas that could well start to to grow again. Housing potentially isn't going to be amazing in the next 6 months, but it looks like it will recover at some point, and they will be very early in the housing sector. So next time you see a housing sector boom, they will be operating on the ground infrastructure fairly early in the projects. So I think you've got a few tailwinds behind them, which should help improve the business and particularly improve that return on capital. So what they're doing is only buying new rigs where they have potential for high utilization, high return on capital around more specialist projects and fewer kind of general piling rigs. Yeah, and they're forecast to grow. Like I say, they're going to have a difficult 2024. So they're on a 4P of about 10, but that drops to 7.5 the year after. And I don't see why with this strategy they can't grow a little bit faster than that. I think this is a business that should be on a PE of 30 ever, but I think there's a scope for this to be back on a PE of 10 and growing EPS at maybe 15-20% in the short term over the next few years, and that will see the business re-rate. And in the meantime, it's sort of protected by the asset value. It's hard to lose too much money if things go wrong, because these rigs do have value elsewhere in the sector. Do you think, Graham, have you been tempted to delve so deep into the deep value of this sort of business?
I'm impressed by various aspects of VANL. I've read it correctly. They have net cash, excluding leases, of 9 million. So that's a quarter of the market cap in net cash.
Yeah,
that's pretty good. Good start. So maybe we could lap that off, say that it's on an even cheaper earnings multiple on that basis. I also saw a lovely sentence in their interim results this year when they said there are no non-underlying items reported in the current or comparative period. So you don't see that very often. Perfectly clean numbers, no adjustments made whatsoever. Pretty amazing. I like the fact that they use return on capital employed as KPI. It's there as a headline number in their results. The ROCE itself, 10%, is okay, moving in the wrong direction, unfortunately, like most of the numbers in the most recent interim results. But okay, 2023 was a tough year, as we know. Lots to like about this one, I would say. You said it shouldn't trade on a PE of 30, and I do agree. The margins are very low, goes with the nature of the industry. Those low margins, operating margin of 4% or something, suggests to me that it is very much in the sort of industry work that should be on a cheap multiple. I couldn't really argue against the current earnings multiple of what you might say that is 10 times or less, perhaps. However, with the net cash position, maybe there's scope for more shareholder returns or maybe another acquisition. I think the most recent acquisition was sized at £4 million, which seems a nice size for the business, and they could do more of that.
Yeah, I was going to say, it's interesting. I don't tend to look at operating margins as much. And yeah, I tend to look at gross margin. I always think the gross profit margin is what kind of stands out for whether something's got a moat or not. And I agree, when you look at the sort of gross profit margin of 30%, you think this probably doesn't have much of a moat and doesn't deserve particularly high rating. But I also noticed that today, they were recording this, that REIT, a company that is quite highly rated, reported their half-year results, and their gross profit margin is lower than VANL. I'm not saying that VANL is as good a business, but I think it shows that there's quite a lot of interpretation in these things. So, Roland, what's your interpretation of VANL?
As you say, I think at the current level, I think a lot of bad news is probably in the price, and kind of all else being equal, I think I'd probably agree that there's a decent potential from here when housing picks up and so on. I quite like the exposure to the regulated sectors. I think it helps to take away some of the cyclicality and maybe also some of the political exposure that some other areas of the market might have. I don't know too much about the competitive landscape for this business kind of with a UK focus, but whenever I look at VANL, I always can't help thinking of it as a miniature version of Keller, which is obviously a much larger business, an 800 million business, but also a groundwork specialist that operates all over the world and tends to do quite specialist activities. But one interesting thing, similarity between the business, is that the operating margins are very similar. So it doesn't seem like, however specialist and accomplished you are, and however much of a long track record you have, you still have these high revenue, low margin contracts. And it does seem that you can gradually build a larger business out of this now that, and for an investor, it could be interesting to look at this level. The shares have certainly come down a long way from where they floated back in around 2017. I think they got up to about 130p at one point. So it's been a long way down, but I've noticed that with quite a number of companies, especially with property exposure that floated around then. Where they are now, it's, as far as to my eyes, seems quite attractive potentially, certainly compared to where they were back then. But yeah, I think VANL would be worth a look if I was looking at that kind of small, deep value.
I guess they probably haven't delivered on their IPO potential, but how many companies actually do?
Yeah, but if you wait around a while, a good business sometimes emerges. A good business and a reasonable price sometimes emerge together, don't they? I think.
Yes. Yeah. That's a good point. Great. So no further thoughts on that. We thought we'd have a quick chat about a topic that everybody has a very different opinion about. So it's sort of interest rates. Now, I'm not going to get into what we think interest rates are going to do, but I think it's an interesting topic. Do you try and predict interest rates? Is it important to you as an investor? Now, Graham, you invest in quite a few financial companies and like that sort of stuff. So is this something that is on your radar? Is it important to your investment thesis? What direction interest rates are going?
It wouldn't be particularly important to me, Mark, because I think as an equity investor, you do want high returns even in a low interest rate environment. So if the base rate is 2% or 4% or something reasonably normal, I think your expectations for as an equity investor should be pretty much the same, because you want something that's a lot higher than that anyway. It doesn't really make a huge difference. I suppose in a very low interest rate environment, which we did experience, you probably do need to rein back your expectations generally for the equity market. And I think most reasonable investors would do that. They would say, if the base rate is 0%, I'm probably not going to earn 20% in equities. There's going to be the spillover effects from zero interest rate policies. And I should say that for a lot of the financial stocks that I look at, interest rates do affect them operationally. That goes with property stocks, obviously banks, all these things. Interest rates there are not just an interesting macro feature. They're something that affect their operations. So in that sense, you do need to be aware. I remember talking about Duke Royalty not that long ago, and I was saying Duke Royalty being a sort of mezzanine lender to small businesses. I was saying the Duke share price is a lot lower than it was before interest rates rose. And what's really changed since then? Obviously, interest rates have risen, which means that as a lender, as a high interest rate lender, your whole business model has changed. And so obviously, if you're investing in lenders, you have to have some awareness of how do interest rate changes affect competition between lenders. That's obviously going to have an impact. But away from financial stocks, I wouldn't worry about it too much.
Yeah, I think I tend to agree with you. I know it makes a difference to sentiment. I know it does change people's perception of the market. But personally, it doesn't seem to me that it should make a massive difference. And the reason is that if you have a low interest rate, then the outlook for the economy should be bad. That's the reason interest rates are low. So actually the rate of growth you're getting from your business should be poorer than in a boom market, and therefore the calculation sort of nets itself out. I tend to disagree with the idea that we should all be obsessed by the direction of interest rates, but I do recognize that it's almost like a greater fool theory. If other people care about it, then it goes into the psyche and it can have an impact. What about you, Ron? Because obviously, like, dividend investing is one of those things where you do have an alternative. You do have the alternative to invest in, say, government bonds. So do you think dividend investors should take note of interest rates?
I think it depends where you're looking for your dividends, probably. I would have said generally, like both of you, that it's not something I give a lot of consideration to if you're investing in a non-financial business at any rate. If it's the kind of company I want to be able to hold for a decent length of time and see gradual growth, then I'd expect managing interest rates is to be something that is just one factor of many within their business model, a bit like not quite like foreign exchange, but maybe in a similar vein. It can be significant at times, but it nets out over time, and it's something that to have people within the business who address that kind of problem. But one area I suppose that really comes to mind, talking about interest rates and the impact that we've seen over the last couple of years, and that perhaps we could see in reverse at some point, is obviously with property, and especially with REITs. Maybe there was a lot of these that seemed to float kind of in the years between about 2014 and I don't know, 2021, and some quite niche ones, not that large, and they did very well for a while, to the point where their dividend yields were between 3 and 4%, and now many of them are offering yields that are more like kind of 6 to 8% or even slightly more. And when you look at things like that, I think you have to recognize that it is just, the whole thing is partly a play really on the cost of funding, and how it sits alongside rental yields and kind of what's left in the middle for shareholder dividends. So there is arguably, it's been suggested, and I can see there's a bit of an opportunity here if you buy some of these REITs that are trading really at quite low levels with high yields. Any reduction in financing costs before they next need to refinance could arguably lead to a situation where they're repriced a bit just to reflect that the cost of financing won't be as bad as maybe is feared. A lot of them at the moment, their interest rates are still hedged and fixed for maybe another 2 or 3 years in some cases, although not always. And so at the moment, they haven't seen the full pain of higher interest rates. They're still able to sustain these dividends. But what happens next is open to speculation. In a worst case scenario, the debt cost will rise a lot more. Their rental pricing won't maybe keep pace, and the dividends could be squeezed out. But another way of looking at it is that financing costs will come down, the dividend will remain stable, the value of the dividend will remain stable, but the rating of the equity might improve again. It's a situation that's probably among the most directly exposed to interest rates that we've seen, certainly this time around. And it's a situation where you might take a view, but it's probably not something I would be all that interested in doing, because I don't have any idea what's going to happen.
You've really got to jump in and look at the details of each company with that kind of thing. So what are the debt maturities, what the current rates, and that kind of thing.
Yeah, looking at the leverage and as you say, the duration, the outstanding lease periods, and the debt maturities and so on. Yeah, there's probably some opportunities there if you understand the sector and are willing to do the research. But it's not a big focus for me, but it is an area where interest rates and dividend yields have really had an effect on one another, and where there might perhaps be opportunities to lock in some pretty high yields that you wouldn't be there otherwise. But more broadly, I don't look at the yield. I hope the yield won't be the only return from an equity, at least with the kind of stocks I try and buy. I'm hoping for a slightly above average yield, maybe 4 to 5% at a portfolio level, but some steady growth on top of that, so the total return is a bit better. So it is a factor, but it's not something I'd base my decisions on as a general rule, other than just to try and keep the yield of my portfolio a little bit above the FTSE average as a kind of simple rule of thumb.
Maybe I could add to that. I may have been a little bit blasé when I said that away from financial stocks, I wouldn't worry about it. As Roland points out, companies with interest rate exposure, especially floating rate debt, which many companies do have, will get shaken by interest rate rises. I think a lot of companies will be paying 10% on their debt currently. Some of the lower grade companies, you could have 5% margin on top of a base rate. And so if you can lend money and earn 10% from businesses of medium to low quality, that does suggest that equity returns should be higher than that. And I think if we did see at some point a genuinely high interest rate environment, then that would shake up a lot of businesses, and you would see weaker businesses really struggle. And so, for example, if we had a base rate of something like 8%, then I would expect as an equity investor that many companies would then be on single digit PE multiples. That would be, to me, that would make sense then, because you'd have an earnings yield of over 10%, which is what I'd want to earn from equities if the base rate was approaching 10%. So the other side of the coin, in a low interest rate environment, I have very modest expectations from equity markets. In a high interest rate environment, I expect the vast majority of companies to be on very modest PE multiples.
Great. Let's leave it there for today. Interesting discussion as always, and good to see you guys.
Thanks for hosting, Mark.
Yeah, great to talk
welcome.
again. Well, that's it for this time. Thank you for listening to the Investors Roundtable podcast. Please like and share if you enjoyed this episode. It really does help us out. If you have any questions for the Roundtable, please leave them in the comments section below and we'll do our best to answer them in the next Roundtable podcast. Once again, thank you for listening, and until next time, happy investing and goodbye.